Powell cuts rates, the government shuts down, and gold hits $4,000 an ounce. Let's talk about it. Hello, everybody. Joe Wirbick coming at you. And Powell, the federal chairman, just recently lowered rates for the first time since December of 2024 by 0.25% or 25 basis points. This is great news for people who want to borrow money at a lower rate. This is not great news for people who like to invest in risk-free investments like CDs and money market accounts, because historically speaking, as the Fed lowers rates, we will see CD rates, we'll see money market account rates begin to fall. And it'll be interesting to see what happens, because currently there's over $7.2 trillion just sitting in money market accounts. This number is the highest it has ever been. I think the majority of this money was government bailout money we got during COVID, but it's just sitting in money market accounts because people are getting 4.5, 4.75 return when inflation is below 3%, and they're going to leave that money in those accounts as long as they're paying rates like this. It'll be interesting to see what happens if Powell actually does do what he said he may do, which was lower rates another 25 basis points in November and then another 25 basis points in December, taking the Fed funds rates from 4.2% down to maybe 3.75% by the end of the year. This is going to have an effect on the overall economy. The one area it's not affecting the way I was hoping is we're not seeing mortgage rates drop. See, the Fed funds rate is not a direct correlation to the 10-year Treasury. And the 10-year Treasury had spiked above 4.5%, close to 5%. But right now, the 10-year Treasury is around 4%. And historically speaking, 30-year mortgage rates are usually about 1 to 1.5% higher than the 10-year Treasury. So we should see mortgage rates at about 5 to 5.5%. But we're not. We're seeing mortgage rates still above 6.5%, close to 7%. So we're talking 150 basis points, 200 basis points more than the 10-year Treasury. And why is that? Because investors are demanding a higher return for the risk of holding these mortgages. They're worried that there could be a default like we saw in 2008. I don't see that happening because banks are so strict and stringent on who they lend money to, and across the board, houses are significantly higher in value now than they were 5 years ago, than they were 10 years ago. I'm just hoping that mortgage rates come under control here and we start to see them heading more towards the 5 to 5.5% where they should be based on that 10-year rate. Other good news, historically speaking, after a rate cut, the next 12 months, we've seen the S&P 500 gain on average 13%. And if that rate cut happens outside of a recession, which we're not in a recession right now, we've seen the S&P average as much as 18% gain. In fact, December of last year, when Powell cut rates, the S&P 500 is up 11.4% since that rate cut. So we're seeing that already, which means potentially we could have over the next 12 to 15 months another 13 to 18% return in the S&P. Now, past performance is not indicative of future returns, but historically speaking, we've seen this. That makes me positive that we will see this market continue to grow for a few more years. In other news, the government shutdown. And this isn't the first time this has happened. In fact, since 2000, we've seen 6 government shutdowns, the longest of which happened from December of 2018 to January of 2019 during Trump's first time in office, 35 days shutdown. But when that shutdown occurred, we saw the S&P, the Dow, the NASDAQ all lose 15% during the shutdown. And this time, the markets didn't lose anything at all. Actually, they've grown since then. And post-shutdown, 1 year later, we saw the Dow up 10%. We saw the NASDAQ, the S&P up 15 to 20% after that shutdown. So what does a shutdown mean? Unless you're a federal employee or you're receiving benefits from a federal employee, it's going to hurt you. But overall, this should not affect the economy. These politicians eventually will agree to disagree again, and we will get the government back open. And in other news, gold hits $4,000 an ounce. So does that mean it's time to invest in gold? Well, gold has been a very interesting investment. If you go back to the early 1900s, gold has only averaged about a 3 to 5% return. The S&P 500, the Dow Jones Industrial Average, and NASDAQ has crushed that return. But let's look at times when gold peaked. 1980, we saw gold hit $600 an ounce and then fall and not return to $600 an ounce for 27 years, not until 2007. So had you bought in the peak during 1980, you would have lost money for the next nearly 30 years. Then gold peaked again in 2012 at about $1,700 an ounce. and then promptly fell and did not hit $1,700 an ounce until 8 years later, around 2020. And then the peak in 2020, gold promptly fell and did not hit its highs until 2023. So as I've said before, past performance is not indicative of future returns, but we've seen historically for the last 50 years, every time gold hits a high, it tends to fall off for a number of years. I'm not telling you should invest in gold. I'm not telling you shouldn't invest in gold, but go into it with your eyes open and realize that since 2015, gold was at $1,000 an ounce. Since then, it's gone up to $4,000 an ounce. So we're talking about a 400% return. I have no idea how long that can last, but you know what else is up over 400% since 2015? The NASDAQ. So you could invest in gold, or you can invest in something like the NASDAQ or the S&P or the Dow Jones, which historically speaking, over the last 30, 50 years, has severely beaten gold. Just saying, not the best time to buy into investments when they're at highs. Typically what you want to do, you want to buy in low and sell high. And I'm not saying you should be selling out of gold, but hey, if you bought it in 2015, a 400% return isn't too shabby. So there's a new format here on my channel, Everything They Never Told You. I will be posting 2 videos a week. One video like this about current economic updates, topics, what's going on in the news. And the second video will come out later in the week about financial planning topics. I finally have some help with editing, so I'll be able to get back to you twice a week going forward. So stay tuned for another video this week, and then going forward 2 videos a week. So if you haven't done so already, make sure you hit that subscribe button. Make sure you hit that notification bell so you are told every time I post a new video, which I will also be posting my television show, Everything They Never Told You. That'll be available every other week. And I have a podcast now, Retirement, Everything They Never Told You, available on Spotify and available on Apple. And that is an hour-long program that I do each and every week. There's already 6 episodes up available right now. If you want to do that, there'll be a link down below in the description. You can catch up with me every single week on YouTube, on Spotify, on Apple. You can catch me on your local TV station, or just come back to YouTube and check out my TV shows every other week. Thank you for watching, and as always, I'll see you next time.